I was planning on doing an update on this anyway, but I got a number of listener requests asking for this. So on Wednesday was the big crazy day. We had the Chinese economic data from the National Bureau of Statistics of China come out late Tuesday night, early Wednesday morning, and that started a cascade in the regular American stock markets, along with bad German industrial data. And what happened then was we got the 800-point drop in the Dow, or around 3.1%. We had the spread, the 10-year and the 2-year go inverted. So it's the first time in approximately 12 years that the entire yield curve in the United States went inverted. Because remember, partially the yield curve had been partially inverted since May, and now the entire yield curve is inverted. And we also, on that day, because of the inversion in the U.S. yield curve on the 2s and the 10s, we also went to over $16 trillion globally in negative yielding debt. And in fact, now we're actually almost to $17 trillion already. That's how quick things are going. So I want to put things in perspective, how quickly this downward spiral is occurring, how quickly this crazy downward spiral is occurring. So we were at 13 trillion in negative yielding debt about 7 weeks ago. So only 7 weeks ago, we were at $13 trillion globally in negative yielding debt. And if you go back into the archives on my channel, if you're new to this channel, as my listener base is growing, almost 2,000 new subscribers per month now, it's starting to really roll because I've been really putting in the work and creating a lot of videos and updates and stuff. But it's just accelerating how quickly everything is going. So 7 weeks, we're from 13 trillion to almost 17 trillion. The move from 15 trillion to almost 17 trillion was barely 10 days. Okay, it was a little bit over a week. In the archives, I think, let me pull this up real quick. The negative yielding debt, it says it was 1 week ago on the archives. It was on, that video was on August 10th. So it was barely a week ago. Crazy, huh? Okay, so what does this all mean? There's a bunch of stories that are attached to this negative yielding debt. And actually, in the short term at least, in the long term, the U.S., this could bury the U.S. more. The U.S. is being given more rope to hang itself with. The U.S. federal government is. In the short term, all this negative yielding debt benefits the U.S., and I will tell you why. So the U.S. government ran officially, its official budget deficit was a 27% increase. So $1 trillion budget deficit increases. Everyone knows we got that deal with the 2-year extension of the debt ceiling. Everyone knows that the Treasury is going to have to go and raise a lot more money very, very soon. The Treasury was almost empty. There were some games that the U.S. Treasury could play in order to delay it, but very, very soon, probably in the next couple months, the U.S. Treasury is going to have to do, hundreds of billions of dollars worth of bond auctions. And the reason this benefits the U.S. is for nominal positive yield compared to the rest of the globe. The U.S. has 94%. There's articles about this. I'll attach it in the information and description section. The U.S. has 94% of all the nominal positive yielding debt, which means that it is attractive to bond investors in other countries. So in emerging markets, in Europe, in China, where there is net capital outflows, that's the key here. Not the gold going into China, the net capital outflows of, are you looking at the capital of stocks and bonds along and subtracting that from gold imports? Okay, so net capital outflows is coming to the U.S. It's going into the U.S. bond market. All you have to do to confirm this is look at price action, look at the tape. That's why we have the 10-year bond in the U.S. at 1.539. It's down from October of 2018. It was at 2.78, the yield. So the yields in the U.S. are coming down because on a relative basis, this does not mean the U.S. doesn't have problems. The U.S. has a lot of problems. But on a relative basis, the U.S. still has nominal positive yields compared to pretty much every other country now. And that's why capital is coming in here. This is reminiscent of, if you're familiar with financial history, 1927 and 1929, after the stock market in England crashed, and there was recessions or depressions throughout the rest of the global economy back then. A lot of extra flight capital came in, capital outflows from other countries came to the US. And that's what accelerated the run up to the October 1929 crash. So, on top of this, the Treasury is going to want to sell more. There's other stories as well. One of these other ones, so the U.S. is going to benefit, at least in the short term, from having a 94% share, almost a total monopoly on global positive yields. Okay, the other stories are, and this is insane, that the Trump administration is actually considering issuing a 50 and 100-year Treasury. So that would, from the standpoint of the U.S. federal government, that would be good. From an investor standpoint, that would be very, very dumb to invest in a 50 or 100-year Treasury bond. And if you don't believe me, all you have to do is look at what happened to Argentina. Argentina, a couple years ago, they had very high demand for their 100-year bond, paying out, 7% yield, and already the official inflation rate, this is the official government inflation rate in Argentina, which is not the real inflation rate. The official government inflation rate in Argentina is around 55%. That's their government inflation rate. And the value of that 100-year bond in Argentina in just a couple years, where there was a lot of demand for that, it has already collapsed, I think, by more than 50%. So eventually people may not even get paid the yield at all. So they've already gotten destroyed on the principal value of the bond, and they might not even get the yield payment soon. Absolutely scary stuff. And not only is the U.S. considering it, Trump considering it, because then they could just inflate away the debt, but Japan's been considering it too. This is something for the last couple years that Japan has been talking about, because Japan has been doing this financial repression, Japanification game pretty much longer than anyone else for 3 decades now. And Ben Bernanke, remember in 2016, I've been talking about this pretty much more than everyone else. Now everyone's talking about it this week because of how much the yield curve's going inverted, and then President Trump considering issuing 50-year and 100-year treasuries. In addition to that, now everyone's talking about the zero coupon perpetuals. Well, guess who was talking about that before everyone else? It was me. I went back and looked through the research. You won't find this on a lot of other channels. Other people probably rip off my work and copy it and not give me credit for it, because that's what happens in the alternative media, and that's what happens in the gold community. I pulled that CLO stuff. I've been pulling a lot of the China information that's not here in the West. Surprised that stuff's not on Zero Hedge yet. So, lots of games from these governments to try to delay the inevitable. They want to fool bond investors. They want to inflate this debt away. If they can raise 50-year bonds, 100-year bonds, those things are going to be inflated away. It's nominal value versus real value. The real value of those bonds 10, 20 years from now is going to be worth way, way less when calculating a real inflation rate with devalued digital fiat debt-based currencies. And I found an interesting article. There is a research firm that's, I think, nonprofit called Truth in Accounting. And someone from Sprott, I forgot his... I can look it up real quick. A second, let me look it up. I wasn't planning on this. Okay, so there's a article from Chuck Chokel, Chokel, on the Fiscal Times about $1 trillion budget deficit for the U.S. is bad. The reality is much worse. I'll attach a link to that in the information section if you want to read that. There was also another interesting article from someone who wrote for Sprott. I'm getting it now. I'm in the Wall Street for Main Street Facebook group, so give me a minute or so. Give him some credit for allowing me to do that research. Let's see here. Since we have such a large audience, where is it? Here we go. Peter Diekmeyer. I know he listens to the program, so shout out to Peter Diekmeyer from, I guess he writes for Sprott Money. Says, Bond King Jeff Gunlock says, with the truth in accounting, the U.S. deficit is $6 trillion using real accounting. I'll attach a link to that article if you want to read it as well. So, we are almost to 17 trillion in negative yielding debt. If you go back and listen to the short podcast I did talking when we were at 13 trillion in negative yielding debt about 7 weeks ago, I looked at that chart there before it got to when it was just at 13 trillion, and I said this chart is going parabolic. It's not going to stop at 13 trillion. It's going to keep on going, and we are going, the angle of the upward chart is just increasing. The angle is getting steeper, and we are increasing at an increasing rate. And this is all what happened. This is what happens exactly with financial repression and Japanification. And then also when you get those net capital outflows out of emerging markets. And what happens is these emerging market central banks, they step in, and people are asking me, well, why are yield curves inverted globally? I've gotten asked this listener question, why are yield curves inverted globally if so much capital is leaving these emerging markets? And the answer is because the central banks in those emerging markets, they step in and they start doing financial repression in QE2, and they're trying to do rate cuts, and they're trying to devalue their currency, weaken their currency, and they're worried about a strong currency for their export market. So you have all these guys all trying to do the same stupid things. Okay? All these evil governments trying to do the same stupid things. Beggar thy neighbor, currency wars, rate cuts. It really is ridiculous. A lot of the same mistakes, very similar mistakes from the 1920s and 1930s are being repeated. I really hope we don't get to World War III, because we know what happened as the economy got worse for a 10-year span up until World War II. Jeff Gunlock is really good, but he screwed up on his yield curve prediction. He deserves some criticism. He said the yield curve would steepen. Hedge Eye said that the yield curve would not steepen, it would go inverted. I covered both sides of this. So we're almost at 17 trillion now in negative yielding debt. I think someone sent me a message today that it was 16.7. We've gone from 15 to over 16. Well, 15 to 16 in less than a week, and 15 to almost 17 in barely a week. Are rates going to zero? Yeah, I think the plan is for ZIRP, zero interest rate policy. There's a lot of people at the Federal Reserve now, they used to not be open to this. They're even writing research papers about negative interest rate policy. Sean sent me a super chat. Thanks, Sean. What do you want to know about the COMEX? COMEX and how the Fed can suppress prices through the paper market is the open interest. They can sell a year's worth. It's the total open interest, Sean, of the paper futures contracts on the COMEX and the LBMA. An entire year's worth of annual silver production worth of paper futures contracts can be dumped in basically seconds onto the market. So they can short with papers futures contracts. They can sell silver. They can sell it short a bunch of papers futures contracts. They can sell short silver. They cannot deliver that they do not own. That would take a long time to deliver. That's how it's controlled. But they cannot push the silver price below a certain level, because then they bankrupt all the primary silver miners. And the primary silver miners provide, I think it's what, 20, it's about 20%, maybe a little bit above that, of the annual silver supply. The base metal miners that have a large amount of silver byproduct, that have about 2/3 of the annual silver supply, the base metal miners, they do not care about the silver price, and they are in bed with the banks. The base metal silver miners will sell their silver byproduct. They will sell it to Silver Wheaton. Used to buy it, but Silver Wheaton, now that it's Wheaton Precious Metals, they had to write off a lot of those silver deals because a lot of the deals that they did on the new primary silver miners all went bad. It's just not economic to bring on new primary silver mines. So Wheaton Precious Metal, Silver Wheaton, now Wheaton Precious Metals, had to write off, either restructure or write off a lot of deals, silver streams for primary silver miners. But the base metal miners that have an enormous amount of silver byproduct, they are willing to give the bankers as much of that silver as they can give in exchange for better loan terms or other perks. And I know this because I've heard it from a number of industry sources. So the manipulation of silver markets is not just with the papers futures contracts, where an entire year's worth of physical silver production can be dumped in the form of papers futures contracts onto the market and sold short in, minutes, literally in minutes at 2 a.m. when the market is illiquid, and they can literally do that almost every day. Although the price action, the rallies of that are responding faster. So in the past, years ago, a big dump like that of papers futures contracts, a big dump like that, which is, if you talk to professional traders, that's not how you trade. Normally, if you want to sell short contracts like that, you sell them into strength. You don't dump all at once. You're trying to blow out stops. You're doing it at illiquid hours. You're trying to intentionally manipulate the market. The other problem, Daniel, with the mining costs, and this is why mining costs rise every couple years, is because the grades keep falling. There is no panacea for that. There is no silver bullet, pun intended. Oh, and the point I wanted to make was that these big dumps in papers futures contracts, it used to take 6 months or a year, sometimes even more than that, to recover from a just massive attack, a raid on the silver futures contracts. But now we're looking at like sometimes weeks or even days. So the rallies are starting to firm up. And that's because everyone is aware that if the silver price keeps going lower, there will not be mine supply soon. The base metal miners will keep producing unless the copper price or the base metal prices crash, which is possible because China's demand, the real numbers in China are very, very low. The real economic data in China is very low. So that could mean that the demand for some of these base metals could stop a lot. Zero rates are not good for the economy. They're good for banks and they're good for governments. The bank can borrow cheap and then issue you a 17% credit card. Negative rates hurts banks though. Governments love zero rates. The zero rates are not good for people on Main Street. The average person or small business doesn't get to see the zero rates anyway. You're not getting lower rates on your credit card. The banks are borrowing from the Fed at cheaper rates, and then they're raising the rates on your credit cards. So zero rates are just to maintain the status quo, to try to keep the asset prices from collapsing. And there's a bunch of reasons why the people in power at these treasury departments and central banks don't want the asset prices collapsing. Yeah, consumers and savers do not benefit from zero rates. I've never been to Australia, Roger, but thank you for the offer. Zero rates also steal. Negative rates are even worse. Negative rates, here's the thing. The European Union is like accelerating with negative rates because they're trying to weaken the euro against the dollar, but negative rates are damaging so many things in the European Union. They're damaging insurance companies, they're damaging pension funds, they're damaging savers, they're even hurting the banks. So ultimately then, the only thing that negative interest rates benefit in the European Union are the heavily indebted, spendthrift, refuse to cut their budgets, wasteful and corrupt governments. I don't know, 12 months to a recession, it could happen sooner. If one of these big banks collapses, like Deutsche Bank or HSBC or two of them, or China has an enormous problem where their dollar shortage is actually revealed, or we find out with actual other sources other than Kyle Bass and others that people come forward that the People's Bank of China did borrow hundreds of billions of dollars to prop up the RMB, that would spell that China's reserves are nowhere near the levels that they claim, and that China's in much bigger trouble. And again, this goes back to the economics professor, the brave guy inside mainland China, who said that China's real GDP was 1.67% last year in 2018. He did a presentation. I think it got over 1 million views either on YouTube or Chinese social media before the video got shut down. And he said that China's real GDP was 1.67% and that the economy was contracting very, very violently. And there's a reason for that. Misallocation of capital, bad central planning, and too much debt throughout their economy. So let me make sure if I covered all the stories I wanted to talk about. I have an interesting Market Watch article from, let's see here, Joy Wiltermuth, talking about how the U.S. Treasury is going to benefit from the lower yields and also the negative yielding debt globally. I wanted to talk about this before I let you guys go. So there was a Bloomberg article that came out on Thursday. And this guy actually wrote 3 ways to profit from 17 trillion of negative yielding debt. And in the article, this guy must be some asshole douchebag hedge fund manager who gets like an extra like 20 or 30 grand a year to write for Bloomberg, because this guy actually wrote in the article, he was suggesting that the way to profit from negative yielding debt and globally negative yielding debt and negative yielding debt increasing is to actually take on more leverage and then do very leveraged and hedged forwards and swaps. So basically do these very, very sophisticated trades with leverage, and that you can pile it on rather than just betting on the principal value of the bond increasing. I'll attach a link to the article. He explains why you should be doing this trade. Honestly, this is not financial advice, but I think that guy, anyone who does that trade who isn't playing around with other people's money is risking blowing up, because he's prescribing a lot of leverage with these forward contracts and swaps. I can't believe he wrote it, but apparently there's demand for it because all these hedge fund managers or private equity guys or all these sophisticated institutional investors need to figure out how to profit off this, even if that means using lots and lots of leverage and risking blowing up. That's the same type of principle, the stupid principle that they do with the leverage short volatility trade, where they play whack-a-mole, the adult version of whack-a-mole with the VIX, with mass amounts of leverage. With technology, we can make communism truly work. No, you can't. You can make it like China. You can have the social credit score system where there's no free speech, and if you criticize the government, if you don't keep your mouth shut and criticize the government at all, you end up in a re-education camp. If you're lucky, they let you out after being tortured every day for hours and or brainwashed. There was no liquidity in 1929 either. There was a lot of credit, and then the liquidity dried up. Everyone had margin calls. The Fed, I believe the Federal Reserve had begun to take liquidity out of the system. So they had created, if you read Murray Rothbard's America's Great Depression, he talks about this. The Fed created the credit boom in the 1920s. So there was a Great Depression of 1920 where the Fed actually cut, the U.S. federal government and the Fed actually did the right thing. And it was very hard for 18 months, but there was a real recovery. And then after the Great Depression in 1920, where the Fed basically did nothing, the Fed then went on an enormous credit binge in the 1920s. So there was a big housing bubble, property bubble in Florida. A lot of condos were built in Miami, and swampland was turned into real estate. And then a lot of people, including a lot of regular people on Main Street, had access to stock margin. They could borrow tons and tons of shares on margin. And then there was a dry up in liquidity when the stock market started to fall, and that caused margin calls, and people did not have the cash to pay for the margin calls. I think ultimately gold's going to be one of the big winners in all this. The lower these interest rates go, and people can, if they want to, there's not financial advice, if people want to copy Stanley Druckenmiller and bet on the 10-year treasury going lower, they can, but you're not going to get any income from it because only the value of the bond is going to go up. But personally, I would much rather have gold than 10-year treasuries. if you want to diversify, you can maybe, there's not financial advice, you can maybe have both. You can play U.S. Treasuries, copy what Stanley Druckenmiller is doing, and then also have gold exposure. And the dollar is back above 98 on the dollar index, although the dollar has not held 98 because I personally think that the U.S. Treasury does not want the dollar above 98. But then you have the European Central Bank that wants a weaker euro against the dollar. So that's why a rate cut, another rate cut, immediately is being talked about by the Federal Reserve. Sean, I 100% agree. This system is crazy. And you know what? We are seeing tons and tons of news stories that are really accelerating the bad news. So this is very reminiscent of what happened. We had a smaller trickle in 2007. By 2008, there was a large trickle of bad news. Towards the end of 2008, we had Lehman Brothers, and that was around September, I think, of 2008. But earlier in 2008, the bad news was really starting to trickle in. So I think definitely in the next 2 years, there's going to be a lot of problems, and it could be even faster than that. We'll see. It depends what the central banks decide to do with QE and stuff like that, because the Fed has not announced an exact date for when they're going to restart QE. In my humble opinion, they're going to have to restart it sooner than later. We'll see. It looks like the Fed is planning, my educated guess, another rate cut in the next month or two, and then QE could start pretty shortly after that. Possible free Nostro Vostro to do bail-in to what's SV Banks in the super chat. Thank you for the 3 super chats. I appreciate it. Dave Rooms, Pebbleman, and Sean. Possible free Nostro Vostro? What's Nostro Vostro? Save Banks? Are you talking about Italian banks? In the European Union, I could see some combination of bail-ins and bail-outs. I have friends who, listeners to this podcast who are European listeners, and they are looking for a safe bank in Europe, and unfortunately, I don't think there are safe banks in Europe. That's the bad part. So people are looking all over Europe for a quote-unquote safe bank. That's the problem. All these banks are discussing whether, if they haven't already done so, whether or not to charge negative interest rates or to increase negative interest rates. The European Union is as bad as the stuff that is being done in the United States by the Federal Reserve and the Treasury. The European Union is doing it on an even worse scale right now. Oh, thank you, Steve, for the super chat. I appreciate it. If this is not financial advice, but if I was living in Europe, I would debate having like a gold money account or one of those types of accounts where it's technically not a bank, or like a stock brokerage account, like a Interactive Brokers account. And then I would keep some savings in there because they're technically not a bank and they're probably not going to use crazy amounts of leverage. So gold money audits their physical gold, and you can use a gold-backed debit card or like a stock brokerage company like an Interactive Brokers or one of those. But you have to check to see if the stock brokerage is doing crazy derivatives bets or other types of leverage. But I believe Interactive Brokers, which is a very solid company, and their CEO has heavily criticized George Soros. I don't think he's the founder has. I don't think he's done any of that stuff. I think in the European Union, I think we could have a combination of bail-ins and bailouts. It would be pretty bad. The stuff being discussed in the IMF, there's an IMF white paper about how they need to go cashless and they need to go further negative. And it looks like the European Union is implementing this first. There's a free white paper from the IMF that you guys can read talking about what to do to either slow down or stop the next crisis, and the suggestions are just ridiculous. About banning cash and putting more punitive negative interest rates. Okay, guys, well, I think I've done enough for the update here. Let me make sure I covered everything. Yeah, looks like I got everything. So I'll talk to you guys later. I'm going to go out to eat and go relax now. Everyone have a nice rest of your weekend. Bye for now.